Hi, Larry Gaines, PowerCycleTrading.com. Well, we're starting to kick off a new earnings season. It kind of starts tomorrow with the banks. So we'll have some bank earnings tomorrow with JP Morgan Citi. And then once we get into next week, we're going to have some earnings on like Netflix and several others. But anyway, we're starting a new season. So I thought I'd show you kind of 3 different earnings cycle trades that you can look for to give you some good trading opportunities as we head into a new earnings season. So I've kind of broke it down into 3 different types of trades. You have the first trade is a trend trade as you go into an earnings release. The next trade, we'll go through, I'll show you some kind of examples of this. The next trade is what we call the earnings release trade, which is a non-directional trade. So you don't know which way it's going to go, up or down. The third trade then is a trend trade or a post-earnings trend trade. So once the earnings have been released, a lot of different companies will have kind of a statistical probability that they tend to trend in the same direction after an earnings release. So let's take a look at these types of cycle trends. So here's the first one. I'm going to show you CRM. This was back, CRM had 3 of these cycle trades. It had a trend trade where price actually trended up into the earnings release. You can see where my pointer is right here. Here's the earnings date. So we had price trending up, in anticipation for good earnings. And then when the earnings were released, you can see it collapsed. Now, the other thing to notice here, trade 1, when you have a trend trade where price starts to trend, and typically most of the time it will tend to trend higher in an earnings release, but the implied volatility, this blue line, tends to always go up as well. So when you're going into an earnings release date where the market is uncertain as to what the earnings are going to be or if there are any other announcements, that pushes up the implied volatility, and the implied volatility is what is one of the major pricing components for the option. So what you want to do here is buy the option series that the earnings release will be in, and if you get a good trend trade going up, the options will actually go up in price because the implied volatility is also going up. So that would be trend trade 1 that you can look for. Now, trend trade 2, or the next cycle trade, is you want to do a earnings release trade, which is non-directional. So you want to be out of trade 1 before the earnings release, because you never really know what the earnings impact will have on the stock. So you can see here that CRM had a fantastic trend up, and then it just cratered and had all this confusion after the earnings release. You can see the implied volatility then collapsed as well. So that's trade 2. So a number of different trades we could do selling implied volatility to take advantage of that collapse. And then trend trade 3 is post-earnings. A lot of times you can go back and look at the statistics of what a specific stock did after its earnings release, and a lot of times they'll kind of have a similar pattern each and every earnings season. And here you can see CRM trended up after its earnings release, so that kind of post-earnings trend trade. So a lot of different ways that you can trade during earnings season, so you don't have to just kind of be paralyzed and sit on your hands and miss all the activity. Now let me show you another example of implied volatility. That's the other thing, like I showed you here, how it moves up. So I'll show you Netflix. It tends to have a really good move on implied volatility as it goes into an earnings date release. So here's a good example of how implied volatility tends to always go up into an earnings release because the uncertainty as to what will happen at the earnings release. So here's Netflix again. You can see this was back in July of 2020 and had a fantastic price move up, but also the implied volatility goes up, and then after the release, that uncertainty is out and it collapses. Here's another example. This was again in 2020. This was the October earnings season, and you can see price did move up again into that earnings release. Implied volatility goes up and then collapses after, and then you can see here coming into the end of the year here. Let's take a look real quick and I'll show you the last example of implied volatility moving higher. If I can get got it coming into this current earnings coming up here, this will be next Tuesday the 19th. So in this situation though, Netflix the price has been coming off, but implied volatility is still going up, so the puts would be going up more in value. So if you'd like to learn more about these types of earnings trades, all the different directional trades and earnings strategies, join me on Saturday. This Saturday I'll be doing a free workshop on how to trade earnings during an earnings season and all the different option strategies that you can use. So good luck trading. I'll talk to you on my next video update.